What's up, everyone? It's Karthik with Money Vest. Welcome on board for our Federal Reserve speech and FOMC press conference, which is going to start in about 45 minutes. We're going to get the statement from the Federal Reserve in about 15 minutes here. The markets are selling off, and Nvidia down a little bit over 6% right now. If you guys can see me and hear me, just give me a thumbs up. I just want to make sure that the audio and the video is working well. I'm still trying to figure out this microphone here. Yeah, if you guys can see me and hear me, just give me a thumbs up and we should be all set to go here. And I'm gonna screen share now. So Nvidia down a little bit close to 6% right now. We got the S&P 500 down over 0.5%, and we got the Nasdaq down over 86 basis points, close to 1%. And we got Tesla continues to sell off. They're also reporting their earnings later today. So after the markets close, we do have a lot of companies reporting their numbers. So if you scroll over to the earnings calendar, we do have companies like Microsoft, Meta, Tesla, reporting after the bell today. And then, of course, tomorrow we've got Apple, Visa, Clark Corporation, MasterCard, not to mention Intel. We've got Atlassian, UPS. The list goes on and on. So it's 4 of the 7 Magnificent 7 companies reporting this week. 3 of them are today. So Microsoft, Meta, Tesla. And that's a lot of market cap right there. They are all part of the $1 trillion club. And of course, tomorrow we've got Apple, one of the largest companies reporting as well. Not to mention Nvidia is going to be in about 25 to 30 days, which is also trading like a penny stock, trading down to about $121, $122. So let's just start a poll. There was Mohammed El-Erian was talking right now earlier on CNBC, which actually on Bloomberg, which I want to play a clip right now before we get into the statement in about 15 minutes. But I want to do a poll right now, so let's just take a look at markets reaction. Let's just do that. Markets reaction after after Powell's speech. Let's just do that. So let's just do a rally or a dump, and that's going to be the poll. Do me a favor, folks, share this live stream with other people so we can have more and more people join us for this Jerome Powell speech. So copy the link, share it on Twitter, Instagram, Facebook, Telegram, Discord, whatever you use. Have more and more people join us, other traders, investors that you feel can benefit from this lively discussion that we're going to have with Jerome Powell's speech scheduled for today, as well as the earnings as well. I am a little bit tired, but I'm going to power through this. It's been a very hectic last 4 or 5 days as my family was visiting, as I mentioned earlier. So been pretty much out the entire day for the last 4 or 5 days, showing them around. And of course, not getting a lot of sleep because I was babysitting my nephew. Super cute. I had a great time. But at the same time, I'm just going to start catching up on some sleep and on some rest moving forward. But nonetheless, we're going to power through this live stream. I'm going to share the link so that you can actually share it with other people. So again, here's the link. Have more people join us. And our goal would be to get to at least 500 votes before Jerome Powell starts talking at 2:30 p.m. Eastern. So we've got about 45 minutes until he starts talking, and we're at 72 votes. So let us know what you think the market's reaction is going to be like after Powell's speech, which starts at 2:30 p.m. Eastern. So first things first, we're going to listen in on what Mohammed El-Erian has to say about the countdown to the Federal Reserve's decision. He does mention that the biggest risk to the market, let's see if anybody can guess what he thinks the biggest risk to the market right now is. So we've got, well over 300 people watching. I'm pretty sure someone can get it right. So let me know in the chat what you think Mohammed El-Erian says about the biggest risk to the market right now is. So Kurt Trader says a rate cut. I want to hear from more people, so I'm going to wait a few more minutes to have more people join us in this discussion, and what you think is the biggest risk for the markets right now. Sammy says rate hike. Abu says inflation. Let's see. We got Rajendra says no rate cut. Sticky inflation. A lot of really great responses, by the way. A lot of really great answers. DeepSeek, certainly been a big risk for the market for semiconductors more specifically. Then we got trade war, we got rate hike, we got rate cut, we got bond yields, inflation, rate cut needed, rate pause for 6 months. So what he says is rate hike. So if there is any kind of repricing in the market and we have any possibilities for a rate hike on the back of a stickier inflation, that would be not great news for the markets at all. So let's listen in what he has to say. Just let me know if the audio is good. If it's not, just let me know in the chat, but I'm pretty sure it's going to be fine. So let's listen in on what he has to say here.
Together at that stage.
Mohammed, I love your take on this because you say that there is a liability in taking this reprieve from the controversy and just offering no guidance, that a guidance-free Fed is one that can come across as stop and go and rudderless. Do you think that the market could be responding or is already responding to that, even if the Fed achieves boringness?
So I think the market has responded to one thing and is yet to respond to a second thing. It has responded to a overly reactive Fed that became excessively data dependent after its mistake of 2021. If you think about it, we've had very little strategic guidance from the Fed since then. And the result of that has been significant volatility in the bond market. The Fed became a fuel for volatility, a source of volatility rather than a counter to volatility. The second thing I don't think the market quite realizes is we are slipping back to the 1970s stop-go monetary policy.
Interesting.
There's a reason why it was discredited in the 70s. And if you continue with stop-go, you will harm the economy. So there's two very distinct issues that are coming together. And that's why what happens after this meeting is going to be important.
I totally agree with that, Mohammed. The idea of after the meeting and onto the dot plots. Ben Steele and Elizabeth Harding at the Council on Foreign Relations published today in Barron's a blistering critique. They dragged Torsten Slok into it from Apollo on forward guidance. What is our world like if we get rid of the dot plot?
So I think the dot plot is excessive and forward guidance. And it's not real forward guidance because the Fed chair is at pain at saying this is the individual projections. They could do a Bank of England, much more meaningful forward guidance is where you get the guidance of the staff. And that has a way of anchoring. Right now, the dispersion in dots, Tom, as you know, is huge. If you look at the terminal point, it's incredible how much the Fed officials differ. So we've lost credible forward guidance in the US. And I think if we weren't able to go back, we wouldn't do the dot plots. I think that was a step too far in transparency.
Mohammed, one thing you've said repeatedly is that this Federal Reserve has failed to take a strategic view, that they continue to be too data dependent, hypersensitive to incoming information. There's another wrinkle now. Some officials on the Federal Reserve are anticipating policy changes. How much weight do you think they're putting on one versus the other?
So it depends which policymaker you're talking about. And that's a problem for the marketplace, is that there are different degrees to which they are willing to incorporate what they think is going to happen. And you're talking about energy, regulation, trade, immigration. You're talking about some key areas that impact the economy. And of course, fiscal, we must not forget fiscal. These are the big five. And then even those who incorporate their view have increasingly, we're starting to see among some, John, a political sensitivity that wasn't there before.
That was delicate. Are you saying that one of the members might be considering a potential seat at the head of the table come 20?
What is the unexpected forward? Let's go to Mohammed El-Erian game theory. Everybody's complacent now. We've all got a theme. I put out today, maybe it's a snooze fest today, and we'll be surprised in the press conference. What's the unknown for you right now?
The Fed being forced to hike. And if we get some hot data prints, and if the Fed still truly is committed to 2%, then it will have no choice but to hike. And that will cause significant market volatility and significant political volatility. So, if you ask me what is one of the things that really would make this market very, very volatile, it is the recognition that a hike may be in our future. I don't think it is, but that's, to answer your question, that's what we'll do it, Tom.
Mohammed, how confident are you that the next move is a cut and not a hike?
It's more likely to be a cut than a hike, but it wouldn't surprise me if the Fed is tempted to stay on hold until the summer.
Interesting. Mohammed, thank you. TK let you off the hook there.
So there you go. I mean, obviously most likely to be a rate cut than to be a rate hike, whatever that next move ends up being. Right now as it stands, the markets are very much priced in for a pause, at least for this meeting, which we are going to get in 6 minutes. 6 minutes to go until we get the statement from the Federal Reserve. So we're going to come over to their website, and the statement is going to be available right here. This is the first meeting that Jerome Powell is going to be. Of course, there's going to be a press conference and the first FOMC meeting of 2025 and the first meeting since Donald Trump has taken office. So as Mohammed El-Erian obviously mentions, if the Federal Reserve is forced to hike, and by forced meaning inflation is sticky and elevated above 2%, and depending on how committed they are to their 2% target, if they're forced to hike interest rates in the future, there's going to be a lot of volatility in the markets, not to mention a lot of political volatility as well, because we clearly know where Donald Trump sits in terms of monetary policy. He wants quantitative easing. He wants very easy and loose credit policies so that there can be significant amount of growth, but at the same time, it can also drive inflation higher, which he also mentioned that this is a very 1970s stop and go type scenario where during Paul Volcker, before Paul Volcker, obviously we did see interest rates getting cut down and then inflation ramping back up until finally we had to increase interest rates second time to eventually kill inflation and bring it back down to under 2%. So is it going to be coming? Is there going to be a round two for inflation? Of course, we'll find out soon because we do have the PCE numbers coming out later this week as well. So on Friday, we do have the personal consumption expenditure. But as it stands, the markets are very, very priced in for no change for at least this meeting. In other words, a 99.5% probability that we're going to stay where we are. So once again, thank you so much for joining, everyone. We got about 5 more minutes left until the statement is released. A very quick update on the markets here. NASDAQ is slightly down, almost 1%. We got the S&P 500 down almost 0.5%. And we got Tesla here down 2%, Nvidia down almost 6%, giving back on almost all the gains from yesterday. It was up almost 9%. It's now down 6%, so still net 3% higher from yesterday, but of course down over 7 to 8% still from the highs from back in Friday. So very, very, very volatile week for Nvidia. For a company this size at almost $3 trillion, it is literally trading hundreds of billions of dollars every single day. I mean, it's getting sold off 600 billion and then adding 300 billion, and then today it's down another 200 billion, and it's just insane amount of money that's flowing in and out of Nvidia, and it's quite literally trading like a penny stock. Because what the intraday changes are for Nvidia, which is the hundreds of billions of dollars, that's the entire market caps of many companies in the US. I mean, $400-500 billion is a very large sum. And, you combine a lot of these blue chip companies like Coca-Cola or Visa or Adobe or, of course, Palantir. There's a lot of companies that are literally worth that much. And Nvidia is moving that much every single day. Just goes to show how crazy this volatility is in this stock. So, just got a few more minutes here. 3 more minutes to go, everyone. Make sure that you drop a like, subscribe to the channel. Still 42% of you guys are watching the channel but are not subscribing. So definitely hit that subscribe button if you're enjoying the content. And also share this link with other people so we can have more people join us and listen in on what Jerome Powell has to say for us. Down 6, up 9% isn't net 3. I mean, I'm just doing some very quick mental math. We went up 9% yesterday, giving back 6% today, so net 3% higher. Of course, there's not going to be an exact number, I know that, but just doing some very quick mental math there. Imagine a hike or a cut, markets would explode in one direction. Yes, that is correct. If we actually do get any kind of a hike or a cut, definitely not a hike, certainly not a hike. I think the Federal Reserve is not going to do that as a surprise, but yes, they could do a surprise cut. in this meeting. But of course, if they do that, the markets will be taken with a surprise, and that could actually be a positive surprise for the market. And I think really the press conference is what's going to be the driving factor in today's meeting, because we already do know that there's literally a 99% probability that we're not getting any changes from a Federal Reserve standpoint. The interest rates are going to stay put at 4.25 and 4.5%. So 4.25 and 4.5% is where the expectations are going to be for the statement here. So a couple more minutes to go. And let's see what these numbers look like. The yields are pushing back about 4.5% here, 4.5.5. Crude oil is trading back down to under $73, and we got Bitcoin just under $103,000 right now, with SOXL basically flat on the day. And so we do have technology once again underperforming, as there is a lot of risk-off environment in this market. And we do have staples, utilities, and communication services, industrials, financials, all pushing higher on the day once again. So the market breadth is definitely getting better. This market is broadening out to other parts of the market, other sectors, so to speak. And technology and semis are the ones that are under a lot of trouble right now. And I think I read some news that Trump administration is also looking to design new export bans for NVIDIA for their H200 chips, which again are going to be some of the more advanced AI computing chips, to restrict that to basically sell them in China. And that's going to hinder some of that progress for China even more, like putting in more constraints for the Chinese to develop these models with regards to artificial intelligence. But with constraints comes creativity, as we talked about in our previous video. So, the fact that there are constraints at that level is causing the Chinese to come up with more creative ways to build these large language models. Anyway, so statement is going to be released in 3, 2, 1 here. So we're going to just double click until the report shows up here. As soon as it does, we're going to read it. There we go. There's a statement. Boom. We're going to open that up, read it, and the committee decided to keep interest rates where they are, 4.25 and 4.5%. So absolutely no change from the Federal Reserve. There we go. They have paused interest rate cuts. And as expected, we did not get a rate hike or a rate cut. That's the statement right there, released just now on January 29th, 2025 at 2 p.m. Eastern. So recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. And that's true. I mean, the labor market has only gotten better, to be honest. Like if I come over to my unemployment spreadsheet and I show you guys exactly where we are. So this is the most recent reading from this month's unemployment numbers that we got. So unemployed persons, as well as the JOLTS numbers, we are now back above 1.17 for this ratio. And the unemployment rate still sits at 4.1, 4.2%, which is still a really, really low number. So you've got a very, very strong labor market. Conditions remain solid. Inflation remains somewhat elevated. So that's the language that they're using, that inflation is somewhat elevated. And the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. And the committee judges that the risks to achieving its employment and inflation goals are roughly in balance, and the economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. And so in support of these goals, the committee decided to maintain the target range for the federal funds rate at 4.25 and 4.5%, exactly where the markets were expecting it to be, and exactly where we were as of the last meeting. So nothing changed as of the last meeting. The markets, not a big reaction. So we did see a little bit of a sell-off, and we're seeing some buyers step back in, and Nvidia is back about 122. We've got Tesla, just a little bit shy of 390. And then in considering the extent of and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, evolving outlook, and the balance of risks. The committee will continue to reduce its holdings of Treasury securities, which has been going on for quite a few months now, and agency debt, mortgage-backed securities, and the committee strongly is committed to supporting maximum employment, returning back to 2%. And that is the same exact copy-paste statement from last meeting. So literally nothing special about this report. So the bigger question for this report is going to be the press conference. And of course, we don't get and SEP, the Summary of Economic Projections, until March 19th. So that's when we'll get the new fresh projections from the Federal Reserve. If you go back to December meeting from December 18th of last year, which obviously did cause the markets to sell off quite aggressively. So if you remember December 18th, the Money Invest Index was back down in the low threes. Volatility did spike, back this right here in the 27-28. So this was December 18th. We did have the Federal Reserve pull back on their expectations for rate cuts. If you guys remember correctly, we were talking about this in our previous videos as well, as this right here, the 2025 target for interest rates, you'll notice was revised up from 3.4 to 3.9%. So that was 2 fewer rate cuts that the Federal Reserve essentially told us in the December 18th meeting. But the interesting part is the market already knew that. The market already was aware that they were going to give us 2 fewer rate cuts, and yet we still had volatility in the markets. We still sold off very aggressively on December 18th. The volatility did spike up to 27.28, and that was a good buying opportunity, right? Hindsight 2020. We also did send out a lot of buy orders because the Money Invest Index and the volatility, both of them were giving us very good signals. And so this right here, revising up from 3.4 to 3.9. And so if you do get to 3.9%, right now we're sitting at 4.25% and 4.5%, right? So if you do get down to 3.9, that is still going to be 2 rate cuts, or at least 50 basis points worth of rate cuts is what we can still expect for this year. So the Federal Reserve right now is still very much in line with what they've already told us back in December from their SEP standpoint. So 2025, they're expecting to close the year at 3.9. And if you come over to the CME FedWatch tool, by December 2025, the market is expecting for us to be right here, which is going to be 3.75 and 4%, which is literally within range of the Federal Reserve at 3.9. So 3.9 sits right in between this range right here, which is 3.75 and 4%. So right now, the market and the Fed, they're both aligned, which is very rare, right? It hasn't happened in 2022, very rarely happened in 2023, and certainly did not happen in 2024. It was fluctuating a lot from the beginning of the year to the middle of the year towards the end of the year. So it's very rare. Sometimes the market is front running the Fed. Sometimes the Fed is giving us a little bit more rate cuts versus the market. So it was very rare to get both of them aligned, and eventually they obviously need to converge because, that's how it works. And right now, in a very rare occasion, we are both aligned. Both the markets, they're pricing in for 2 rate cuts, and the Federal Reserve, as of their December meeting, have also told us 2 rate cuts. And the next SEP is going to come out in March. So March 19th is when the next Summary of Economic Projections come out. And if for whatever reason the Federal Reserve reduces their rate cuts even more from 2 to 1 or from 2 to 1 to 1 to 0, then that obviously is going to create more volatility for the markets even further. On the contrary, though, if they increase their rate cuts, that is only going to provide us a little bit of a boost for the market. And between now and March, a lot of political pressure is going to come to Jerome Powell's way and the FOMC's way, because Donald Trump is certainly not going to be wasting any time to try to create this environment for growth on the back of lower interest rates. So lots to look forward to in the future. I mean, I think this is going to be a very, very entertaining and interesting year for the market. So this is the first meeting. And like I said, Jerome Powell is going to be taking stage in about 20 minutes or so. And so we'll listen in to what he has to say. I think there's going to be a lot of questions, a lot of political questions, which I think he's just going to skip past them and just be ready for a lot of very similar questions and very similar responses from Jay Powell. Okay, just coming back to some of the questions here. So Kevin says, bring out the purple tie. Yes, I was looking at a couple of different memes. The tie is gonna be the greatest indicators of them all. The tie color is gonna tell us which way the markets are going. Tesla puts their calls. Vinny is asking. So it's kind of hard to say. I mean, I've already got calls, 800 and 850 calls that are up anywhere from 45 to 52%. I'm holding them through earnings. If Tesla drops, in the 370s or 360s after the earnings, I will most likely be closing those calls out. If I'm up anywhere from 70 to 80%, we'll be locking that premium, and then we'll be selling newer ones at a lower strike. We'll most likely be selling new ones at 700 and 750 strike. as opposed to the ones that I have right now, which are 800 and 850. So we'll just be making that adjustment. If Tesla rallies, then I'm not really doing much. I'm just holding whatever I have, the shares as well as the calls that I've sold that are still going to be up, right? I mean, Tesla would need to go up to over $800 by the end of this year before those calls are in the money. So I'm more than happy to let them expire worthless. So for Tesla, not doing much. If it drops, we'll be closing out calls and selling new ones on the next green day. If it rallies and rips after the earnings, just holding whatever I have. So kind of net neutral going into these earnings. Either way, it doesn't really matter. And that's the beauty of trading options and also investing for the long term, is that you're able to maximize your potential for profit, generate some cash flow, and it's a lot more stress-free because you're not really betting on one direction or the other. You're really just taking advantage of volatility either way. So if it goes up, great. If it doesn't, if it goes down, also fine. Because long term, as long as the company is executing well and is on track to, increasing the revenues and cash flows and profitability, you're on track to performing well. And that call basically that you sold acts as a very good hedge to generate some cash flow and, of course, some buffer to those underlying shares that are coming down in value. Okay, how do they even calculate these odds? So there's obviously futures market. That's, real people betting on those trades. And that's how the pricing and the probabilities are calculated for almost everything that you see. A lot of these financial products, that's how they're calculating those odds. His tone regarding future cuts will be the catalyst. Yes, that is correct. I think his tone regarding what the plans are with the FOMC and what they're planning to do with rate cuts is really what's going to drive the markets right now. And like I said, there's going to be a lot of questions, which I think mentally we need to be prepared for, that he's going to be asked about the new administration, about the political interference and the involvement of Donald Trump in the monetary policy discussion. There's going to be a lot of questions about it. So I'm quite excited about this meeting. I think it's going to be a good one. This is simply neutral. He can get puffy on Trump comments during the meeting. So, should United sell Rashford or keep him? Ian is asking. Man, I don't even know. I've tuned out this entire season now at this point because I feel like we're gonna get relegated, and if we do, like, I'm gonna have to really reevaluate. Like, if I just need to stop watching for the next couple of years. So right now I'm not even. I have literally no opinions on United right now. I'm just like, do whatever they want to do. At this point, I'm just like, everybody out and just redo the entire club. Just absolutely redo everything. New manager, new management, new players, everything should be just replaced at this point. Because it's just, yeah, it's stressful every weekend. It's stressful. Do you think Lam Research earnings will be today? Could you do a technical analysis on Lam Research? Yes, absolutely. So let's just quickly take a look at LCRX. So, or no, it's LRCX, right? Yes, LRCX, Lam Research. I really do like this company. I've done a couple of videos on them already. So if you take a look at how it's been trading, a lot of consolidation vault, and I would put down his support right about here at around $70, and we've got a very strong resistance for Lam Research around $85, $86. The manager is excellent in United MS. I mean, every manager is excellent, man. I mean, there was nothing wrong in my opinion with. I feel like the best manager that we let go of was Mourinho, but then Ten Hag was also pretty good. I think Alex Ferguson made a mistake choosing David Moyes as a successor back in 2013. I think that was mistake number one, and then of course since then we've never been able to do really well. But look, I can go down this rabbit hole, which I really don't want to talk about right now. We're here for FOMC and we're here for the Fed, so I really don't want to divert this conversation to talking about Man United right now because, as fans, we're suffering, so I don't want to prolong our suffering by talking more about it. Anyway, so Lam Research, yes. So Vault, I would be watching $70 as support, a resistance at $85. Skanda says market will dump today if the Fed says no rate cut. I don't think they're going to say rate cut. I think they've already plugged in 2 rate cuts in 2025. And I think they're going to continue to point to the data dependency all year. And they're going to continue to kind of convey this message that our goal is to bring inflation back down to 2%, keep unemployment steady and low. Unemployment is at a great place. Regardless of what we may think from a conspiracy theorist standpoint that the numbers are fake, the numbers are not real, whatever. This is what we have to work with. And right now, as it stands, we do have over one job available for every person that's unemployed, right? So 1.17 jobs available for every one person that's unemployed. So that is a very, very strong and very healthy labor market right now. When it comes to inflation, though, we are elevated. We are a little bit more, of course, higher than what the Federal Reserve wants it to be. So if I show you the dual mandate, let me just go over that. Dual mandate, Fed, there's a bullseye chart that you can look at, right? So the bullseye chart shows you exactly what the Federal Reserve is looking to achieve from their monetary policy. So this right here is the dual mandate. And you'll notice on the y-axis, we've got the core inflation, which is stripping out for food and energy, which seem to be a little bit more volatile. So when you strip those two commodities out, the core inflation needs to be at 2%. That's their target. And then on the x-axis, you've got the unemployment rate, which is going to be a little bit over 4%. So, if you look at this chart, and we've talked about this on the channel before, right now, where we are currently is somewhere over here. So this is the circle. Consider this the bullseye. This is where the Fed wants it to be, right? 2% inflation, a little over 4% unemployment. That's the perfect place to operate at. But right now, since we are at 4% unemployment, but we're nowhere near close to 2% inflation, we're over here somewhere, right? So since we are over here, we're obviously higher on inflation, but we're on par with unemployment. But when they are playing around with interest rates, there's definitely a balancing act, because if they increase interest rates too much, yes, they're helping the inflation situation, because as things get more expensive, people are spending less money and everything starts to come down. And so inflation comes down, but with higher interest rates comes job losses, potential for recession, something in economy breaking down, and that comes unemployment, right? So what might be the good recipe for lowering inflation might be a bad recipe for increasing unemployment. So you might be coming down, but you might also be going far out, and thereby going from all the way up here to more to the right. And so this right here, the fourth quadrant, which is like the top right quadrant, is the worst place for the Federal Reserve to be from an economic standpoint, right? This is the place where they never want to be at. This is still okay. I mean, you're a little bit higher on inflation, very low on unemployment. This is in fact where we currently are. This is also okay. You are low on inflation, at least prices are low, even if slightly unemployment is higher. And this is obviously one of the best places to be. You've got low inflation and low unemployment at the same time. But this is the worst. You've got high unemployment and high inflation at the same time. And so this is what the Federal Reserve is trying to avoid at all cost. And of course, in 1970s, when inflation was so high, they had to increase interest rates so much that led to a recession. Yes, it brought inflation down, but it really created a lot of job losses, a lot of unemployment. In fact, you can actually see that in our spreadsheet. So if I come over to the great inflation, you can see the unemployment rate actually went up to as much as 10.7%, the highest level since 2020. In 2020, we were at 14.4% with over 23 million people that were unemployed. But because of the population growth, I mean, since 1970s, there was 226 million people in the U.S. That has now grown to over 332 million. And the total eligible workers have also gone from 182 to 266 million people. Even a small increase in the unemployed persons is not going to trigger the same level of unemployment rate. In other words, if you go up to 11.3 now, right, you'll compare the same unemployed persons from 1970s, 11.3 versus 11.3 is a huge difference, right? From 10.7 to 6.7% unemployment rate. So these are very important things to kind of understand because it helps us get us an idea of what numbers are really deadly for the economy, for the market, from a recession standpoint, from an employment standpoint. And so if this number starts to get up to in the 20 million, that's when things will start to really break down. And things can really be dangerous for the market moving forward if we were to get unemployed persons at that level. Okay, so just wanted to explain and go over just a few things for all of you. As it stands, we got Tesla here still down 3%. We got Nvidia selling off down to 120s, a little bit over 6%. Looks like S&P 500 and NASDAQ are accelerating their sell-off right now, with the NASDAQ down a little bit over 1.2 and S&P 500 now down almost 90 basis points at the moment, and VIX is back above 6.5% higher on the day at 17.49. If I come over to this spreadsheet, which is also very interesting, if you go over to the VIX summary, 17 is still a normal reading for the volatility. So what this basically shows you is the percentile for the VIX. And we have gone back, 25 to as much as 28 years, going back to understand and analyze volatility. And 17, from a historical measure standpoint, is still a normal reading because we're in the 45th percentile. It is not until after it gets up to over 28.9, so call it 29. If it's not until after it goes up to 29 that we're in the 90th percentile or higher, and that's a very rare reading. It starts to become even more rare the higher it goes, and so that's going to be a better and better buying opportunity for us. Okay, let's take a look at some of these questions. Don't forget, I'm a Tottenham season ticket holder. Worst time ever, man. I feel ya. Okay, so Meta, let's take a look. Meta's been doing really well. By the way, ASML giving back on a lot of those gains after having some very strong numbers. It's still up close to 4%, but of course, nowhere near close to what it was up during pre-market. It was up a lot, trading up to 725. But Meta here, trading near all-time highs now. And they are reporting earnings today. So very, very important day for Meta. By the way, I did have a few different links opened up for us. So the Fed meets for the first time since Trump's term started. And this right here was Meta's expectations for the fourth quarter earnings. And revenue is expected at $47 billion, EPS $6.77. And the capital expenditures, of course, for AI, they've already committed somewhere between $60 and $65 billion. Isn't it crazy like how the market sometimes starts to feel like the higher these numbers are, the more optimistic and bullish markets become, when in fact it is actual expenditures. Like these are literally capital expenditures. And DeepSeek, DeepSeek really pokes hole in this kind of thinking, because if you really think about it, shouldn't it be the other way around? Like the better and the more optimistic and bullish thing should be for companies to be spending less. There should be a race to spend less and achieve more. Rather, it's like the opposite. Like, okay, if they're spending 50 billion, we're going to up this to 65. Then the other company is going to up it to 85. And now we're going to be spending 95 billion. Okay, so another company is going to be spending $100 billion. It's like a competition of spending more, when in fact it should be a competition of spending less and achieving more. So the output should be greater with less spend. So that's what's making you more efficient. And I think DeepSeek puts that into context a lot. Like, by only having a budget of around $5 to $6 million. Of course, this is not accounting for all the R&D, all the different equipment, and a lot of different things that went into building that R1 model, even though it was called a side project or a side gig for the quant trading firm. But it still kind of explains why it is important for these companies to be more efficient than having this competition of who can spend more money on building AI infrastructure. Because I think at the end of the day, like if you're spending more money, that is less profitability, that is less margins, less bottom line for the company. Because if you think about it the other way around, when companies announce layoffs, is that a positive or a negative catalyst for the company? I'll let you guys answer that question. When companies announce layoffs, when they said that, oh, we're cutting our workforce by 5%, or we're laying off 5,000 people, or we're laying off this department, this department, all the jobs, we're just letting people go. Does the stock usually go up or does it go down on that catalyst? It's in most circumstances, it's a positive catalyst. It's almost always a positive catalyst for the stock, because what does Wall Street think? Okay, they're not going to be paying, because labor is one of the most expensive things for any companies, right? So they're definitely, if they're spending less on labor, that means bigger bottom line, bigger profit for the bottom line, which is higher earnings per share. But for some reason, when these companies announce these capex at these ridiculous levels, it's somehow a positive thing. when it should be more on efficiency. And, one of the things that we also look at when we do our fundamental analysis is profit per employee or revenue per employee. And you can kind of see a trend over the last 7 or 8 years and get an idea that, okay, is the revenue per employee and the profit per employee going up or going down? Because if it's going up, that means the company is becoming more efficient. They don't need to hire more people to achieve more productive levels of revenue and profitability. They can achieve more revenue and more profit by the same number of employees or a slightly more employees. And that is one of the best measures of efficiency for a company is revenue and net income per headcount, per employee. Anyway, let's see. Meta at an all-time high, breaking out from this range, still within the context of this rising wedge. However, it's having a blow the top off rally right now. RSI, MACD, everything is a bit more stretched. We already went over the earnings expectations, and support level is going to stay put at $637 right now. I think Wall Street thinks the CapEx spend will increase future revenue as well. That's true. That's absolutely true. That's how they see it. But then, of course, and I feel like Wall Street and analysts, and it's sometimes, when you look at a lot of these technical companies, right? For example, NVIDIA, it is a very complicated business, right? On the surface, it feels very simple. Okay, they're building chips, the brains behind most hardware. But then when you start to kind of really dig deep, and I spend a lot of time kind of learning about what exactly is it that R1 is doing that other large language models weren't able to do. So obviously there's this big component of a reasoning model, right? Where there's little to no human intervention. And even I couldn't explain it to you if you asked me to, because there's a lot of technicality, a lot of math that goes behind it. And so sometimes I actually do wonder that it's possible that it really is people with technical backgrounds to fully grasp what is it that separates DeepSeek with OpenAI, with Anthropic, with Cloud, with Meta, like all these different companies. How are they different? And sometimes, and Tom Lee puts it really well. He says that markets right now, Wall Street and hedge funds in most circumstances, like markets, they fire, ready, aim. And my brother and I were talking about this, and it's just so true. It's so true. And we've seen this over and over again, that markets fire first and they aim later. In other words, they sell first. The first thing, if some uncertainty hits the market, the first button they click is sell. Sell, sell, sell. They're like, get me out of the market. I will evaluate the situation later. I will think about it later. Just get me out. I need to protect capital. And so that's what they do. They sell first and then they reevaluate later. And oftentimes it ends up being a very stupid decision because then it's driven on emotions than anything else. And people who can sustain that level of panic or that level of fear are the ones who end up making money over the long term. And so for me, like after learning all about it, and of course learning about Jevons paradox, which we talked about, that as the cost per use case comes down across the board, across the industry, the use case and the spend only increases. It doesn't go down. So the demand for chips, the demand for GPUs, the demand for high, more advanced compute is only going up. So this is good news for NVIDIA. This is good news for Meta. This is good news for all these AI companies. And since it's open source, it can be utilized by the world. So yeah, I mean, that is what I believe the truth is. But we'll have more time to learn more about it, discuss it, and definitely talk more about it on several of our videos. Anyway, so we've got Jerome Powell coming out in the next 4 minutes. So make sure that you drop a like, everyone, subscribe to the channel, and we are ready to listen to what Jay Powell has to say in about 4 minutes here. Trump is holding a press conference during the Powell talk. Oh my God. We can't really stream both of them. Trump is ready with his huge pump. Sitting in cash right now, Isaac says Trump tariff is going to make a repeat of what happened in 2019, 2020. It actually happened in 2018, I think, towards the end of 2018, early 2019. I still remember there was a lot of U.S.-China trade wars with tariffs, and the markets went into a bear market. I still remember this day because it is like so clear in my head. I was sitting in class. I was back in college, sitting in one of my finance classes. We were talking about why the markets are selling off, and we were literally discussing, because this happened towards the fourth quarter of 2018. And that entire class, the theme was, obviously discussing why the markets are selling off, what are all the macroeconomic factors involved. And we were talking about the US-China trade war and the tariffs. It was such an interesting time. So, 2018, we had a bear market towards the end. 2019, we recovered really well. And then, of course, first quarter of 2020, COVID hits. And since then, it's been a blur. It's been a literal blur. It's happened. Everything's happened so fast. So VRT, we're going to discuss also. I've seen a lot of comments on VRT, so we will discuss that as well. Tara, what's your opinion? Think Meta will rally higher or dump on earnings? It's really hard to say. I mean, I kind of stay away from making these kind of predictions. And, as I've said before in my previous videos, like even if I knew what the numbers were, I would still not be able to predict with 100% accuracy, because that's the beauty of the market, right? You just never know how the markets are going to take that news. You could have the best beat in revenue, EPS, guidance, absolute blowout numbers, and the stock could still drop 10%. I believe that's what happened with SoFi. I mean, SoFi came out with some fantastic numbers, and the stock was still down 10% after the earnings. And so, you could have all the numbers and still not know how the market's going to react. So I kind of stay away from making those kind of predictions. So where's Tesla going today? Again, also no idea, to be honest. Nobody can really tell you with any certainty. But what I can tell you is that we've got a very strong support for Tesla at 375. If that level holds up after the earnings, I think that's a good sign. But if you do break down for whatever reason, if we see a pretty big sell-off here post earnings and we break down below 375, then we really need to be ready for 350s or possibly in the low 300s as well. Anyway, so Jerome Powell is talking now. He's going to be coming on out in the next 10 to 15 seconds. So I'm going to be doing a very quick audio check. So let me know if the audio is working as soon as he comes out. And we should be all set to listen in on Jay Powell. All right, let's do this, folks. Let's listen in. And do me a favor, just please subscribe to the channel if you haven't already. We're closing in on 92,000 subscribers, and here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. it's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact.
Thank you.
Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I would say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer run, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much, and I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold, waiting to see what comes down. It's a very large economy, and policies affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel the economy, that policy is restrictive, suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy's well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation, and as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question, but to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available, and as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks. and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each Teal book, you can look at the 5-year-old Teal books and see their alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it was it changed everything. So things happen, and but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, that then we seem to be set up for further progress. But being seemed to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. And so it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good, but if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Edward.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?"
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So, if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Andrew.
Thanks. Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course, as I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know, and the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So, let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support the smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And a separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018, there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But, you know, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective. And we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level. Because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But, overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see there's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But you don't see that in the aggregate data yet. But yes, you hear it anecdotally.
Nick.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? that was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut, or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts.
It's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, we said, what we said was that, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision we looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and sound. As a good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities, and that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So.
And with respect to households and their inclusion in the asset class?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have the securities laws that we have. It's why if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
All right, everyone. So that was the entire 45-minute meeting. A lot of very similar questions. Of course, a lot of conversations around the political discussion and whether Trump has had physical contact with Jay Powell, or if anybody from his administration has tried to pressure him into lowering interest rates. But Jay Powell standing his ground, talking about the Federal Reserve's independence and making decisions on their own for the betterment of the public and in the best interest of the public. And so keeping interest rates where they are, after 100 basis points worth of cuts, they believe that they're now in a place where they can move a lot more slowly, and the balance of risks, of course, being a lot more equal for both inflation and unemployment. However, inflation's still pretty elevated, which they changed their language on, and talking a little bit about how they're waiting for more data to make more decisions. So as we discussed in our previous videos, that the Federal Reserve has been very, very data dependent, and as a result, they are still going to continue to let data be the more decision maker for the Federal Reserve, and the 2 more rate cuts that are expected in 2025 are still on the table from the Federal Reserve standpoint. So that's all for today. Thank you so much for joining for Jay Powell's speech. That wraps up the FOMC meeting for January 2025. The first meeting is in the books. The markets, of course, being very, very volatile. We were selling off prior to the numbers coming out. Then we pushed up, and then we sold off again. And then, of course, as soon as Jay Powell started talking, we moved up once again. And so the S&P 500 is still down over 41 basis points. And we've got the NASDAQ down over 0.5% as well. So thanks again for joining. Don't forget, we do have a lot of earnings coming out later today. So we do have Meta, Microsoft, Tesla all reporting after the bell in less than 1 hour. And so those are very important earnings. And again, I want to remind everyone there is an additional 20% discount available until February 1st. So this expires in literally 2 days. So today is the 29th, so 3 days. And with that discount, you can pretty much get access to everything our MoneyVest community, which is Discord, MoneyVest website access, all the trade alerts, portfolio updates for just $19.50 a month. You can join that with a link down below. So thank you so much. As always, if you have any questions, please feel free to reach out. I'm more than happy to help. Our community is growing every single day. We've got more experienced traders, investors, very successful, very professional people that are here to support you. We genuinely want to help you. So if you have any questions, please reach out, and I'm more than happy to help and assist you with any questions. Investing, trading, portfolio allocation, financial planning, asset management. We're here to get you to your goals when it comes to finance and investing. So join, link down below with that additional 20% discount, expires in 3 days. As always, happy investing. I'll see you all in the next video.